Hello, I am 𝗥𝗲𝗙 𝗖𝗍𝗀 from 𝗢𝗙, and yeah, there's no tea in this mug. Let's begin the video. If you knew that the world's 100 richest people had all come from the same country, you might not think much of it. However, if you knew that a lot of those 100 people had come from one small rural classroom in Oklahoma, you might want to know what was being taught in that classroom. The success of Benjamin Graham's students, not just Warren Buffett, all of his students, is why the intelligent investor is so highly regarded in the investing world. Having just finished this book, however, I wish I could recommend it to everyone and say that it's filled with investing wisdom that will make you rich. However, only chapters 8 and 20, The Investor and Market Fluctuation and Margin of Safety, contain lasting wisdom that is still relevant today. The big change from when this book was published is that the internet has made it possible for everyone to get access to all company financials instantly. But then of course what followed was a massive overemphasis on formulaic investing. And this formulaic investing style still is very persistent today. This leads me nicely into the first advantage of logic over formulas. Formulas show correlation, logic shows causation. Of course, fast-growing companies have great financial growth. Fast growth happens when companies do something logical. However, if a company grows too fast, this might look fantastic in the formulas and the financials, but it could destroy the business. We see this a lot in nature. Scientists have done studies on trees, and the trees that grow with the most sunlight grow the fastest in the early stages of life. However, the trees that grow in the forest, they grow at half the speed when they are younger, but they grow to twice the size when they're older. So why is this? Why is this the case? Well, let's look at it in the real world. If a company that produces houses were to suddenly start producing houses at twice the speed, well, then you can assume that these houses are also going to be half the quality. However, logical investors will not miss this. In fact, a logical investor may see a company that has been selling less and less houses for a few years has suddenly got a contract to sell 200 homes. Therefore, what you'll see on the balance sheet is a steady decline in earnings, but what you know is coming is a massive jump in profits. Without the logical cause, not a single brilliant stock will ever make sense, because absolutely every single stock breaks formulas in some way. So this leads me on to point 2, exceptions. As I've said, even great stocks can break formulas. Greggs, a stock I made a video on very recently, has two main assets: its shops and its factories. Its stores are very cheap and fast to build, and it builds about 100 a year. This year it plans to build 160. Its warehouses are incredibly expensive to build. So again, a store is very cheap, and if the store gets placed in a bad location, they can shut it down very easily, no big loss to the business. Set up a bad warehouse, however, and you've set up something very expensive and for no great profit. However, if Greggs were doing really well and becoming very popular, which they currently are, then they might decide to do something dramatic like build 3 warehouses in 1 year. During this year, the formulas are going to break and their earnings are going to look terrible. And of course, it's going to take a while to build the amount of stores that these warehouses could even facilitate. But if one warehouse 3 years ago led to explosive growth today, you can make a logical assumption that 3 warehouses is going to make even more exponential growth 3 to 5 years into the future. This is another great example of how real-world investing will lead to both exponential earnings growth and also break any logical formula. This leads me nicely into customization. Logic can be custom made really nicely to fit into different businesses and different valuations. In the example of Greggs, I can use logic to assess 3 things. How much do Greggs make per store? How many stores will they have in the future? And how profitable will those stores be? This logical way of investing is very different from how I would value Apple, Microsoft, Tesla, or McDonald's, and that is why I think it works. Once I started using customized logic for each stock, one of the main things I was able to notice was if the company was doing better than itself 10 years ago. I found that it's actually more important to be able to know whether a company is doing better than itself than it is if it's doing better than the S&P 500. Which actually leads me nicely into the next reason I like logic over formulas, and that is expectations. Formulas can set expectations way too high, while logic is much harder to break. Let's use Apple as an example. Let's say in a year that the S&P 500 is doing really well, Apple is a little bit down. In a year like that, it can be really hard to know what exactly to do with your investment. However, if you can see that Apple sold X iPhones at Y price 10 years ago, and today they have sold 10X iPhones at 10Y price, it's going to be easier to understand that a dip in earnings is just that, a dip. If Apple are hitting all their logical targets but still not hitting your formulas, it's going to be likely that Apple have invested heavily into some sort of new product line, like potentially the Apple Car in 2025. Okay, so we are nearing the end of the video. One of the main reasons logic is just so much better than formulas is logic is simpler than formulas. Hard work is a part of all successful companies, but not hard work for the sake of it. I remember being at university and there were some students that worked so fucking hard, but got terrible grades every time, while there were these other students that would sort of move along effortlessly. And one day I spoke to one of these students that seemed to be so effortlessly, and what he told me sort of changed my life forever. What he said was basically, I spend 10 times longer on the idea and make sure that I've got an idea that will get me a good grade, rather than immediately starting on the first idea I have. The most valuable insights you get will be when you are away from the computer and out in the world and just thinking about the future. As I said at the beginning of this video, investors have always used formulas to predict the prices of stock. One of Benjamin Graham's big frustration is that people at the time were using formulas in the wrong way. But to be honest, the real big difference today is that there's just so much access to the information. Instead of just looking at past growth as a predictor for future growth, you've got to ask yourself, how is it going to grow? If you can't answer that, don't buy the stock. But if you think that it can grow, then you need to ask yourself, how much? Is Apple really going to sell 10 times more iPhones in 10 years? If you think the answer to that is yes, then how? Because Apple was in way less markets 10 years ago than it is today. If you don't think Apple's going to sell 10 times more iPhones in the future, where's the growth going to come from? Is it going to come from Apple TV, or will it come from something like the Apple Car? If it's going to be the Apple Car, how are they going to sell enough Apple cars to justify their current earnings? To use Greggs as an example again, what they need to do in order to grow their earnings is build more shops and more factories. The only risk to me as an investor is that they might run out of places to put them. Already in some cities they have 2 or even 3 Greggs. Given that Costa, in my opinion, a much worse business, has 14,000 stores across the UK and Greggs has only 2,400, I know that Greggs are way off from any form of saturation point. If you're a Star Trek fan like me, you've got to apply less of the Ferengi vibes and more of the Vulcan vibes. It's only logical. But if you really want to be rich, you've got to do this.